Hello and welcome. You're watching KYC. Today we have a unique company in the oil and gas space that we'll be covering. We're talking about Deep Industries today. Let me first start off with what I want to know with regard to where Deep Industries is concerned. They've guided for a 25% growth. They're seeing good growth tailwind. But for how long is really the question, because it's a small company, 3,000 crore in terms of market cap, and therefore the tailwind can be very, very strong. The question is, as the base starts to creep up, and it's done a decent growth clip over the last 3 years, and you'll see those numbers, as the number, absolute number in terms of top line goes up, for how long can they grow at 25%? Really, that's going to be my question. The second one is they've announced a 500 crore capex. Now, I want to know everything about this. The funding, I also want to know what this does to capacity, and maybe not capacity per se, but in terms of top line capacity. How much bandwidth in terms of top line does this capacity expansion give to Deep Industries? And the third piece is with regard to ROEs, therefore, because it's such a large capex project, what the ROEs will be at the end of it, or maybe a year or two as this fully starts to kick through. Margins at 40% plus, they've guided that this is sustainable, but of course there's a possible downside risk from maybe a raw material price or otherwise. I'd want to explore that and understand that better. Now, Dolphin Kandla, this is the big piece, because there is a huge one-time knock which the company has taken in FY25. Likely that will not trickle through, but is there absolutely any additional risk with regard to Dolphin and Kandla, or is it fully provided, is what I would want to know. And what the possible upside to it is also something I'd want to know. So both set of risks, downside as well as upside. Then I'd want to know how much will Dolphin and Kandla contribute to margins, because this is more backward integration. So how much will this contribute to the margin number of Deep Industries, and how much otherwise can the margin number go up by in any case, is what I'd want to know. They've guided for maybe a 2% inch up in margins this year. 40 to 43% is the band they've given for margins. Last off, client concentration. Of course, very few players in the space, and therefore the clients are concentrated, but is there a thought process to diversify at all, and if so, how, is what I'd want to know. But let's start off with what the company is about. And we did say, and I did mention, that it's in the oil and gas exploration and drilling industry. It provides 70% of, or rather covers 70% of the value chain in oil and gas post-exploration. And that value chain is largely what drives the numbers for a Deep. So let's understand the products and services better. One is the natural gas compression. This boosts gas pipeline pressure, and it calibrates the gas pipeline pressure, and that is one of the services that it provides. Second is gas dehydration, that removes water from the natural gas, making the pipeline safer. Third one that they do is workover and drilling rigs. Now, this is of course for new rigs and maintenance of old rigs as well. So both of those is what this service covers. The fourth piece is integrated project management, end-to-end project execution when it comes to oil and gas. Charter hiring gas facilities is also what they cover. Full gas processing systems end-to-end is what they take care of. Production enhancement contracts, takeover and boosting oil fields already existing is also the other piece that they take care of. And then there is offshore marine services, where they provide supply vessels, tugs, and accommodation barges as well. So all of those are provided by Deep Industries. Then there's equipment manufacturing, and this is basically compressor boosters which they provide, among other equipment that they manufacture as well, and they provide as well. And then of course it's trading. Specialized equipment is what they trade via international arms that Deep Industries has. So all of this is what they do. In terms of business model, let's understand that as well. They manufacture some compressors, chemicals via subsidiaries based mainly out of Gujarat, but the core is renting services equipment to oil and gas firms, and a lot of them are Indian PSUs. So you have a decent recurring income which continues to come through as well. They also do selling, or rather they operate sites, they sell services, or rather they operate sites through in most Indian oil states. They also have forayed into global expansion, UAE, Africa, Mexico. How much of that diversification is actually playing out is what I'd also want to know. So that's going to be a key. Last one is with regard to raw materials, whether there's any risk of that. Well, you know, in a nutshell, the risk is extremely low. Those are some key inputs for you in front of you. That's with regard to raw materials, certain suppliers as well. Let's pull those up. And those are fairly standard. And commoditization, yes, chemical spares, there is some bit of commoditization, but not too much. Price fluctuations are surely a possible downside. Timely availability of specialized machinery is the other big downside. So if you don't get machinery on time, you aren't able to execute all the contracts that you have. And that's something you want to keep in mind as well. So that's broadly the understanding of Adeep Industries. Let's start off with the 8 metrics that we'll talk about today with regard to Adeep: income statement, balance sheet, cash flow, return ratios, shareholding, street cred. We'll look at guidance that the company has given and thereafter derive valuations and try and see where it is, where the 5-year average price to earnings is concerned versus what valuations currently sit at. All of that on KYC today. Let me start off with the income statement. Now, in terms of top line, it's done 21% on a 3-year CAGR basis on the top line. You see the way in which top line has moved. It's moved from around 322 crore to 576 crore in FY25. There's been a consistent growth. The guidance continues to be 25%. We'll come to that when we come to the guidance metric. EBITDA has gone up by 26%. In the same time period on a CAGR basis. From 116 crore, it's come to 231 crore now, so doubled. Margins have also inched up from 36% to 40%, and profitability has gone up from 71 crore to 134 crore, which is a 24% CAGR. But something to keep in mind is you have a one-time knock on that net profit number of 251 crore in FY25, which we have ignored for the purpose of this calculation. Why have we ignored it? Because it was due to an acquisition, or rather a couple of acquisitions that Adeep Industries made of assets where the assets weren't fully, the receivables reflecting in the assets and the inventory wasn't correctly valued. So they've done an accounting adjustment, consolidated all the assets into Adeep Industries itself to try and work out efficiencies, and that's why there was an exceptional loss. The point being, it's a one-time exceptional loss. That's something to keep in mind. That's the trajectory in terms of margins that you are seeing. Now let's look at the balance sheet, and in the balance sheet as well, first off, this is a 3,000 crore market cap company with a near 1,800 or 1,900, 1,850 crore book value. So that's for your reference with regard to the price to book. The borrowing number is also fairly low at just 205 crore. Very strong capex is what they've penciled in. And the cash and bank balance currently sits at around 51 crore. So fairly healthy in that sense. For a 3,000 crore market cap company, borrowing is not too high. This includes short and long-term borrowing. So 100 crore roughly each. So that's the whole picture with regard to the balance sheet. We've given this a thumbs up as well. No concerns. Let's talk about cash flow now. And when you're looking at cash flow, largely we've given this a neutral only from a perspective that cash flow, yes, very, very healthy. But the CFO to EBITDA in FY23 was slightly lower. So there's been some bit of choppiness with regard to CFO to EBITDA. That's something you want to be mindful about. But unwind has happened in FY24-25. So it doesn't look as bad at this point. Net cash flow, not exactly the metric you'd want to look at in a company which is investing quickly into capex. So that's something to look out for as well. They will continue to invest in capex, so net cash flow may not really come through, but again, not the appropriate metric. Operating cash flow is what we will look at, but we've given this a neutral out of abundant caution. Let's look at return ratios now, and you'll see the return ratios are on an upward trajectory, but they've not crossed 12%, and that's for me a bit of a concern. Can it cross 12? That's a question we'll pose to management as they continue to ramp up on capex. But 8, 10, 12, at least there is some bit of consistency to it. There isn't wild choppiness. We've given this a neutral, giving the management a little bit of benefit of doubt with regard to return on capital employed. But broadly, this is one metric which you really want to look out for, because if you're doing large capex, you want to see that the ROCE of the company is solid. So you want to keep your eye out on this one if you're looking at Adeep Industries. Let's look at shareholding now, and you'll see a decent shareholding sitting with the promoters. Very low interest from FIDIs, public hold the rest, and even in terms of number of shareholders, they've jumped substantially from FY22, where there were just 17,000 shareholders. You're currently sitting at 38,000 shareholders overall. So that's one metric you want to kind of consider if at all you are an investor. The number of shareholders has gone up, no FIDI participation, but a thumbs up nonetheless, because the promoters own a very solid 63.5% in the company. Let me now talk a little bit about street cred. And the street cred, 1 month the stock is up 9%, but you look at the 6-month trajectory, negative 21%. Year to date, negative 16%. 1 year, the stock is up 50%. And 5 years, it is up 22x. So what we've seen in a nutshell is that over the longer period of time, as the performance has really picked up with regard to this one, you've seen very strong returns. But in the near term, we've seen that there isn't as much return that investors have made. Is it time to be cautious or not? Well, we'll look at valuations, of course, and that will give us a better picture. But that's the street cred that we see at this point. Now let's look at the commentary that's come through. And this is an important one, because you want to see and you want to be sure that the commentary that's coming through is good. FY26 top line, 25 to 30% growth is what they've guided for. 40 to 43% margins is what they've guided for. They've also guided for PAT to grow faster than top line. We'll extrapolate some of these numbers when we look at valuations. Kandla and Dolphin's receivables are nearly fully provided, is what they've said, but I want to know whether there's a downside or upside risk to that. Contracts with Indian PSUs are fixed, so there's visibility with regard to where growth is concerned. And you also want to therefore understand where do return ratios stack up at the back of all of this, if at all that is the case. But we've given this a neutral out of abundant caution. That is on the guidance. Now let's look at valuations. You've got FY25 to FY26. If top line were to go up by 25%, that's the top line number you'll see, which is 720 crore. EBITDA at 40%. We've been conservative here, lower end of the band, but likely this will be slightly higher. I will give you the number if it's slightly higher as well. So EBITDA margin at 40%, you got an EBITDA of 288 crore, very close to 300 crore. And this is only in a case where you are virtually doing a 40% margin. If you're doing a 43% margin, it's a little in excess of 300 crore. So maybe 310 crore is what the top line will be. And revenue also, I'm building in lower end of the band at 25%. If it's 30%, then the revenue number will stand at 750 crore and the EBITDA number will stand at 330 crore. So that's something you want to keep your eye out on as to where it stands, and maybe we'll get some color from management. Now, profit. Profit at 30% growth versus the current year, removing the one-offs, will be around 175 crore. That places the price to earnings multiple at around 17 times. If profit were to do, say for example, 35%, then the number will be 181 crore and the price to earnings will be around 16.5 times 1 year forward. That's just 1 year forward I'm extrapolating for, or rather 9 months forward. Now let's talk a little bit about the market cap to EBITDA as well. That stands at less than 10%. The 5-year average price to earnings on Adeep Industries is around 15 or just below 15. So it's trading roughly at the right price point when you're looking at the 5-year numbers versus the 1 year forward price to earnings. That's the way one should look at it. Maybe a 10% premium on the price to earnings number, but an upside surprise to earnings could well reverse that. And mind you, we're looking at just 9 months forward. So FY27, that's what most analysts currently are looking at, then maybe this number changes a bit. So something again to look out for. But that's valuations. We've given that a neutral. Let's stack up now all of the metrics and give it the final KYC rating. Let's look at, okay, so those are the first 4 metrics. Income, balance sheet, that's how it's stacked up, and those are the last 4. One thing that stands out here is probably no thumbs down. And if at all, and it's 5.5 on 8, but if at all one were to just try and give a possible one big monitorable here, it's the return ratios, and we'll quiz the management with regard to that. Let me bring on board Rohan Shah, Director, Finance and Group CFO, Deep Industries. Rohan, we've spoken earlier. Thanks so much for joining. It's a pleasure having you here. Sir, give us the color. You've won a couple of contracts as well this quarter. And I don't want to talk about Q1 FY26, understandably on silent period. But what is the top line shaping up as? You've guided for 25 to 30. My question is, can it exceed 30? Is there a positive bias to that top line guidance that you've given?
Hi, good morning, Hersh.
Good morning.
Definitely the way we have guided in past, the growth is appearing very promising. And we are gunning towards year-on-year growth of more than 30%. So this year also we are expecting growth somewhere above 30%.
So how long can you grow at this 25 to 30% kind of band? So FY26 will be a strong growth here, 30% plus. What does that do to FY27, 28? Give us a slightly zoomed out picture, 2 to 3 years.
So based on our current order book, whatever we are just giving a guidance is based on existing order book itself. And based on this existing order book, we expect that next 2 financial years, we would definitely grow above 30%. And for FY28, if we'll have to talk, whatever new projects we would be adding in our existing order book, that would help us in growing FY28. So there is a clear visibility of next 2 years, which should be more than 30% growth.
Got it. So you should be at 1,000 crore in terms of top line by FY27, if I'm getting this math right. Let me, sir, talk to you a little bit about EBITDA. You've acquired Dolphin Kandla. What does that do to your margin number? And you started off also on a lower margin base in terms of FY25. So how much will be the organic margin pickup as a result of this and the inorganic margin pickup from the acquisition of Dolphin and Kandla?
See, organically, our EBITDA margins have been in range of 40 to 42%. And with acquisition of these companies, we are anticipating to improve it further. So organically, 40 to 42% is growth we are anticipating going further. And with these acquisitions, this EBITDA margin can go as high as 45% as well.
Got it. So okay, so upward bias to margins. How quickly can it go to 45? In the next 2 years, sir?
We are expecting in next 2 years, yes.
Got it. Understood. Okay. I'll pull out the numbers as well. So on the 500 crore capex that you're doing, what is the kind of funding that where are you going to get that funding from? You're sitting on around 50 to 60 crore rupees of cash, maybe a little bit more at the end of Q1. Where does the 500 crore come from? Are you planning a QIP? At what value will you plan a QIP?
See, the capex we have planned would be funded with mix of all different resources. One is, of course, as you rightly mentioned, the internal accruals. We will definitely take some amount of debt as well, because we are fairly, or I would say highly, very confident on taking debt, because our debt equity is very much in control. And we may think of raising equity as well. We have taken all approvals for raising equity through QIP, and we might go for QIP as well, depending on the market conditions.
Sir, give us some color. So if you were to do a QIP, you've suggested at the end of Q4 in your con call that you will do the QIP at the right price. What to you is the right market capitalization?
See, based on the growth which we are envisaging, based on our existing order book itself, year-on-year growth of more than 30% is something one should cannot ignore. And with such improved margins, the valuation which currently we are getting, we believe it is quite on lower side. And we'll definitely look for some good PE multiple and some good valuation to come in by market recognizing our growth and the margin prospects.
Okay. Okay, I won't push you on that count, but would it be something in the range of 20 to 25 times 1 year forward? Is that something that you're more comfortable with? And if you get that valuation, will you do an equity raise?
Yes, we can look.
Oh, understood. What happens if the equity raise doesn't go through? You do a debt raise, and that is a large amount of debt to take on your book. You have around 200 crore of debt already. How much will be the debt raise? Because you plan to do this entire 500 crore capex in FY26 itself.
See, as I said, we are quite comfortable on taking debt because our existing debt is very minimalistic. Probably we are the only company in this industry who is having such low leverage on their balance sheet. And so taking debt of 300-400 crores is not an issue at all. So even if in case we'll not be able to raise equity, we can definitely fund this capex through internal accruals and debt.
So, sir, what is your current cost of debt? Give us that picture.
Our current cost of debt is in range of 8.2 to 8.5% per annum.
Understood. And you'll probably add another 300 to 400 crore of debt if at all you don't get equity or if you don't get the right valuation in equity. Is that what you're saying?
Yeah, we are pretty much comfortable in raising debt.
Understood. So another 400 crores of debt at around 8.5%. Even if I take that as 9%, that's around 40 crore of EBITDA shaved off in interest cost. That's broadly the take, right? That's how one should look at it. And therefore, your profitability. And so, okay, what does this 500 crore capex do to your top line? Give us that picture. For how long does this capex suffice, and what is the max top line you can do on the capex that you're undertaking?
See, in our business, the mobilization time for deploying any particular asset in a project is ranging from 4 to 8 months. And so whatever capex we do in a particular year would fairly start earning in next financial year. So the capex which we are planning in this financial year will definitely start earning probably in Q4 or in next financial year. And this capex will definitely add to a great amount contribution in our top line. And this would be additional to what we are envisaging as of now.
What would that top line be? Would it be 1,500 crore? Can you give me a number?
See, in our business, generally 500 crores of capex would give you annual revenue of to the tune of 350 to 400 crore.
Understood.
And this particular assets have a useful life of more than 20 years. So we can use these assets for 20 to 25 years.
Got it. And the 1,000 crore top line that you're guiding for in FY27, without this capex, can you do 1,000 crore, or what is the outlook with regard to that? Give us that color.
Yes, as I said before, this growth of FY26 and 27, we are envisaging on existing order book only. And for that, there is no need of any further capex. So 1,000 crore we can achieve without capex.
Understood. So if you do the capex, your top line can easily go from 1,000 to maybe 1,500, 14 to 1,500 crore, or 1,350 crore at the very least, 1,500 crore at the most. Am I right when I assume that?
Yeah, you can assume that.
Point taken. Okay. Sir, give us color on Kandla and Dolphin, the receivables as well as the inventory that you carried over there. You've provided a certain number. Any more provision which may be required, or any amount that you haven't provided for? That's my first part of my question. Second part of my question, is there any upside, which means will any of that money actually get realized or come back? Do you see that happening?
See, we have experience of acquiring now more than 3 companies from insolvency, and we have seen that we have been fairly able to recover their old receivables to the extent we can. And with regards to Kandla and Dolphin Shipping, we have already taken write-off of inventory which was not there in their books. So that has already been written off. With regards to receivables, we will give our best efforts to recover out of this old receivables of these targets. And we are quite hopeful that we can recover at least 25 to 30% of it in current financial year. Probably we'll give a try for next 2 years to recover and then can take a decision.
Wow, that's amazing. So, sir, what was that receivables number? Give us that perspective. 250 crore is what you wrote off. But how much of that was inventory? How much was receivables?
So whatever we had written off was majority was inventory.
Okay.
We had written off almost 250 crore, of
Yes.
which 240 crores were inventory and 10 crores were receivables.
Got it. So, sir, on a 500 crore capex, if you're doing 350 crore at the very least in terms of top line at a 40% margin, right, that gives you a ROE of maybe 20%. How quickly do you get there? Because you're currently at 12.
See, in our return ratio, I would request you to evaluate in a way that there is one item of goodwill is lying in our balance sheet, which is a non-cash item of almost 400 crore. So while calculating any return ratio, one should exclude that part because that is a non-cash goodwill and we haven't paid anything to acquire that. And so to my mind, calculating correct return ratio, you should exclude that. So that will give you the correct picture of return ratio. And the existing return ratio, which we are at, would definitely tend to improve going forward with an increase in top line as well as margins, because going further, we are expecting to improve on margin fronts as well.
Got your point, sir. Thank you so much. This is super insightful. You've been very, very candid with me. Thank you for that, that conversation and that perspective that you've given to us and our viewers. But thank you, sir. But that's all the time we have, viewers. Thanks so much for tuning in to KYC from myself and the whole team that puts the show together. Thanks so much for watching.